I'd like to quickly introduce our panel for this evening. So we actually have Professor Michael Huth, who's hosting it, and I'll just introduce him in a second. We've got Erica Young from the Anthemis Group, Matthew Bradley, an investor at Ford Partners, Robert Benson, who is also an Imperial alumnus of the Business School and an advisor at New Data, Oliver Harris, FinTech in residence at JP Morgan, and finally Andrei Kirilenko, who's with us at the Reverend Howard Center. So stellar lineup, and we're all looking forward to hearing what you've got to say about FinTech and some of the technology developments happening there. So without further ado, I'd like to hand over to our panel chair, who's Michael Huth.
Thanks very much. Thank you for coming. I'm a professor of computer science, so this is not quite finance, you may say, but then again, this is actually a sign of the times. So I am doing research in blockchain technology. So I have a current project on IoT applications for intelligent transport systems. Again, you might think that's not very close to finance, but then again, there's all sorts of added services one could have in there. I also have a project coming up next year on dynamic insurance policies. So this is very much in that sort of market. So I think this is a lot about also, the technical people trying to understand the financial technical people and the business people, and those in the social sciences also trying to understand those kinds of communities, to be able to create something together that's quite interesting. So let me just give you some examples of trends in this kind of theme of the when. So one I can think of is 70% of all Swiss are not satisfied with their current insurer. Yeah. And there's a startup called WebFox, which is based in Switzerland, I guess, which is trying to provide a very modern sort of user-facing, user-centric way of doing insurance. And so this is a potential disruption. But then again, disruption might not necessarily be disruptive in terms of the big players. So another example is Augs Money in Germany, which is an online platform for peer-to-peer credit. And it's quite interesting that a large Dutch insurer, Aegon, has actually committed to investing in this thing. I think it's like 1.5 billion euros in the next 3 years as a way of actually offering credit on that platform, partly to actually spread their own risk portfolios. That's quite an interesting kind of thing. Another thing I would like to mention is acceptability of these kinds of things and the potential of end consumers actually disrupting by the offerings that are out there. So for example, Sweden is more or less factually a cashless society. You can pretty much pay even in very northern remote parts without any cash. So the Swedish government is trying to launch a digital national currency at some point. And the technology is sort of on the way, I guess. But it's quite interesting to see that the Swedish population, fairly recent poll was showing that only 10% of the Swedish citizens would actually accept or approve of having a national digital currency, which is quite interesting given how cashless this kind of society is. Another example I would maybe mention is a UK startup, Nuvara. So they basically work in a FCA sandbox as well, and they're trying to come up with more cost-effective ways of doing bonds, cutting some of these legal costs and so on. So these are just some of these examples where it's not necessarily also finance in the conventional sense. You might actually imagine, say, a steel company, trying to provide financial services in the construction industry. Yeah? This is something that the banks must understand. There's a UK law, I think, coming into force anytime soon in the construction domain, actually, which forces that invoices have to be paid within 30 days. And I think the construction industry is now actively looking into how they could actually do that amongst themselves. Yeah, and again, this is something for the banks to think about, how they might be a part of this. So these are just some of these examples to maybe pave a context for our distinguished panelists. And I would like Erica to lead on her presentation. Thank you.
Everyone. I actually don't have slides, so I'm not going to put you through or force you to read a lot of fine print back behind me. I'm going to talk a lot more about the how as opposed to the what as it relates to innovation that's happening in financial services technology. So my name is Erica Young. I work for Anthemis Group. I do not have a financial services background. I do not have a corporate background. I'm really looking at it from the outside in. My degree is in industrial design, and I've been working for about more than 15 years in product development, and predominantly focused on hardware. As we all know, hardware is hard. and robotics, clean energy, and IoT. So that's what I came to Anthemis with a background in and a foundation in that I used to kind of explore this space of innovation in the context of financial services. So the way to think about that is bringing agile methodology, bringing design thinking, bringing iterative development processes to the space of innovation in this context, and actually looking at what we call venture design, which I'll talk a little bit more about later. So this is really comparing and contrasting the existing tools and methodologies that are used by corporates to innovate outside the context of VC and startup world, although that is one vehicle that they do use to innovate externally, and whether those tools are really fit for purpose. And so that was kind of the lens by which we approached the idea of venture design or designing businesses. So we, and maybe as a blanket or as a caveat, I'm not saying that any one of these tools are not valuable. It's just a matter of identifying what tools are fit for purpose. So in the right context, in the right situation, with the right incentives alignment, any of these tools can be valuable, but oftentimes they're not used effectively within corporates. And that's what we were looking to address with the creation of venture partnership and venture design. So what often happens, I'm going to take you on a little bit of a journey, what often happens in the context of corporate innovation is, particularly in the context of financial services, is you get a letter from the BlackRock CEO, and you are the board of X company in financial services, and they say, if you don't know how you're going to handle the disruption in your industry, you're out of luck. We're not going to invest in you anymore, right? And so then you're like, so this impending pressure or concern about disruption is what drives you to hire a head of innovation, right? So you set up an innovation lab, which is like a hammer when everything looks like a nail, right? So you start doing an awful lot of activities that are where the things that you're developing are not aligned with the incentives of the business as it's running as usual. And so these misalignments of incentives make it as though anything that you develop is not going to get adopted by the mothership because it's rejected like an organ, right? Like if you have an organ implant and the body rejects it because it doesn't see it as itself, right? So this is a really common problem that we saw in corporates that we were looking to address with this type of product. The other thing that you see is there's the classic, and there are a handful of examples of this, of like the Silicon Valley pilgrimage, right? So all the board members and the CEOs and the leadership of the organization get their hoodies and they go to Silicon Valley and they see how the real startups do it. Of course, this information generally doesn't translate or filter down into the organization and doesn't create a culture of innovation in the way that is intended. And so it ends up being these kind of like throwing spaghetti against a wall types of activities that don't really result in anything meaningful. Certainly doesn't result in step change innovation within an organization. So another common tool that we explored and looked at very closely was the accelerator, right? The accelerator, the startup competition, the hackathon. And these types of products, as you might call them, or mechanisms, similarly fall on deaf ears. And part of the reason is that there's just so much noise. And there are so many opportunities for getting involved in a hackathon, and there's very little output from that actually translates into the organization into meaningful innovation. I looked last, or I think it was this week, Wednesday, there were 30 startup events in in London, just on meetup.com. 30 events in one day. You couldn't possibly get involved in all the things that are available, and so you basically end up not going to anything. So the people that you want to attract in terms of innovators can't be found, right? They're busy actually getting some work done. So this idea of like really not having the tools that are fit for purpose are what set us on the path of exploring the space of venture design. And it really comes back to aligning the mechanism with the incentives that you want to produce. And so in this particular situation, in corporate innovation, you might be thinking, I'm dealing with issues of retention. I'm dealing with issues of recruitment. I'm dealing with issues of brand, right? Being clear about what actually the problem is you're solving might be incremental innovation. This is a very possible desired outcome for your activities. Or you might actually be looking for step change innovation. And that's what Larry from BlackRock is asking you to consider. And so if you don't have a tool in your tool chest that's doing that, then that's something that is that's a big challenge for a corporate as they look at the activities that they're involved in. One way that people tend to address this is corporate venture, right? So if we know that startups are really good at step change innovation, we place minority investments in those startups and we see them thrive. And that works a good chunk of the time. That's great. The challenge is the alignment of financial return and strategic return. Because for a corporate, they've got basically kind of a double bottom line. They want the financial return of a good quality investment, which typical traditional VCs are quite capable of producing. But they're also looking for a strategic. They're looking to future-proof their business. They're looking to hedge against threats or risk to their business model. And so those types of things can't always come in the same package as a good financial investment. And so what I do at Anthemis is I run a venture partnership. And what that is I work with a large South African insurer. We gather signals from the market, from our advisory business, from our investment business, from their internal team. We get a sense of what the competitive landscape is, where the opportunity lies, and we surgically design a business to fill that gap. So when I say I design businesses, I don't mean that I find a startup and I incubate them. I don't mean that I find a startup and I accelerate them. I don't inject capital into an existing team. We're actually building the teams from the ground up. So we are identifying what the product or service is, what the business model would be, who the founding team, what are the capabilities, kind of the Kostler gene pool engineering, if you will, if you're familiar with that post, and then identify founders that we know within our network that could actually achieve that vision. And then we inject pre-seed capital into that business and we help it get going, get on its way. And so our goal through that is to achieve both the financial and the strategic return. And in that way, be able to add another tool to the chest of corporate innovation and also generate proprietary deal flow for our venture capital firm. So I would love to talk more about this tool when we get into the panel discussion as a new way of the how of innovating within this space. Thanks.
So next panelist is Matthew Bradley.
Yeah, there you go. Hello, my name is Matthew. I work at a venture capital firm called Forward Partners. We invest in super early stage businesses. So that's solo founders right through to late seed, even early A businesses, early Series A businesses. And the reason why we think that we can take those quite insane risks is that we have a large team, actually not so dissimilar to what Eric has just outlined, of developers, designers, talent people, product people to help these businesses get off the ground, and really to help them sort of execute day by day. And similarly, really looking forward to getting into the panel discussion and exploring that a bit more. But I've got 7 minutes to talk to you about what's going on in fintech. Chris said, name some trends, tell us what you're looking for, and give us some examples, and here's 7 minutes. So let's go. Fintech, what's going on today? WorldPay is saying yes to $9.5 billion from, is it Vantiv? Is it Vantiv? Yeah, Vantiv, sorry. And the reason why Vantiv, which is an American payments company, is buying a UK payments company and that JP Morgan was interested in buying that payments company is because people aren't using cash anymore, because more people are transacting online, and because payments is data, it's information, and that is, as we'll see very shortly, a powerful thing. Going back to 2008 quickly. In 2008, a lot of people lost a lot of hair, a lot of people lost a lot of jobs, a lot of people lost a lot of money. And that's irresponsible, and it resulted in this, which is compliance, I think, yeah. So it's good when the slides actually match what you're actually trying to say. So what did compliance actually result in? So it results in more rules and regulations, and applying those rules and regulations and complying to them is expensive. So the cost of doing business goes up. And also with increased scrutiny, what tends to happen is increased transparency as well. So that increased transparency and knowledge about the financial markets resulted in things like that. like TransferWise, because all of a sudden you knew quite how much a bank was, well, as TransferWise would have it, ripping you off for making payments in different currencies. And there's no good reason for that, so they unbundled a bit of the bank and made it significantly cheaper because they have a lower cost operating model. This is another example. It's in primary bond issuance, much earlier stage, but still a kind of interesting business. As I said, they're hiving off these parts of the business model because banks, where these things used to exist, are now bound up with rules and regulations, and it's expensive for them to do business. Then the last thing is this marketplace lending thing. This is a bit like sort of ham-fisted to cover this all in one slide, but marketplace lending was also a big thing because banks had to step back from areas which they were lending to before because it was too expensive to make those loans. And yes, so alternative pools of money stepped in. Incidentally, I think that this one's got still quite a lot of road to run here in the UK. We've got houses that no one can afford, and a whole load of dry powder in the private capital markets, and I suppose you don't really have to be a genius to work out that soon enough the private capital is going to start investing in the property market and allowing more people to get on the property ladder. Heard it here first or second. Right, so now that that's out of the way, let me talk about AI, because I'm a venture capitalist and now all I do all day is talk about AI to people and say I'm really on the lookout for AI deals, but that is actually true. So AI's here, it's going to be big, but actually more interestingly is a subset of AI called machine learning, where computers write their own algorithms and they get incrementally better without our interference, and that is, I suppose, the very nature of transparency through data with this magic technique of machine learning applied to it. So, I'm going really fast here. Go back. So this, what we have at the moment, and I'll allude to it a little bit later, is a kind of perfect storm of this regulatory scrutiny on financial services companies. You have hardware innovations with processing units, which are, of course, better than they ever have been, but really allowing complex calculations like never before, as well as these huge data lakes, which financial services firms are sitting on top of. And until now, the hardware and the know-how hasn't been able to be applied to it, but now it is. And so all of a sudden we're going to be able to apply machine learning to these data lakes and these pools of data that these financial services companies have, and draw out some secrets and draw out some insights. And that's going to benefit a whole load of people. It's going to benefit Joe. This is apparently Joe Average. I asked, this is from a graphic designer at a venture capital firm, and that's the best he could do. I said, draw me Joe Average, and this is Joe Average. So there you go, there's Joe Average. So Joe's going to get superior services. The fact that lower cost business models are available and this unbundling of the bank is happening, what it means is that I think it was a CEO of Morgan Stanley, Mac the Knife, back in the day, was saying, look, we don't care about people who are earning underneath X amount because they're below the bar. We can't afford to service them. It's not worth taking the risk on them. Well, now that bar is significantly lower because you have these super low-cost, unbundled business models which aren't laboured with legacy systems or anything like that. Mobile, the fact that you've all got smartphones, or at least I hope you do, that proximity to a customer and the proximity to the way in which you use your phone, what is on your phone, when you use it, so on and so forth, translates into, it will for canny operators, translate into superior customer learnings, and that means better products being built. It's the same kind of theory with Netflix. Netflix know who you are, and it knows what you like, and it knows when you like it, and then they make shows literally for you. And that's the reason why the shows that Netflix produce tend to be more of a regular hit than standard broadcasters who don't really know that much about their customers at all. There's also some more regulation coming down the pipe with PSD2 and an increased level of data transparency, so more people are going to be able to do more things with more data, and like I said, the more data with machine learning, the better. And you get nice companies like this, like Motif, which is personal investing, Lemonade, which is an interesting take on insurance, and Monzo, which is a mobile bank here in the UK. Some of you probably have these prepaid debit cards. And look, this is a famous venture capitalist who's also an investor in Monzo and very happy with it. Who would have thought that? So it seems to be working. Now, it's not just for Joe Average, it's for Gordon as well. Gordon, who works at the bank. He's also going to benefit from this because this perfect storm of hardware, know-how, and data is going to result in the ability for banks to move away from some of the things which banks and financial services companies to move away from some of the things which got them in trouble in 2008, which is approximation, let's say. So they knew that they were approximately right, but unfortunately the approximation turned out to store up a lot of trouble, and then eventually that approximation was totally wrong. And a lot of that was sort of proxy blamed on distributions, and this increased power of understanding, this increased power of compute is going to result in significantly better analysis, pricing, risk assessments, so on and so forth. And the people who get there first will make the most money, and you've got a couple of examples here. Kensho, which is a big fancy hedge fund data tool, and Improbable, who just raised 500 million for fancy data visualization. I mean, that's really sort of doing them down. But really, it's an amazing sort of platform which allows you to simulate the world, but in virtual reality. And for modeling purposes, that's a big deal. And if you don't believe me, here's BlackRock. And BlackRock can get rid of a whole load of their portfolio managers towards a more quantitative approach, which is literally what we just talked about. So as I said, the people at the forefront are really driving this already. It's already happening. Now, finally, last slide, I think. It wouldn't be a talk about fintech if I didn't talk about blockchain for a little bit. So what's going on now in blockchain? People are raising absurd amounts of cash unbelievably quickly in what's known as initial coin offerings. Initial coin offerings are an interesting development, and there's clearly utility to them. From my perspective, it kind of looks a little bit like crowdfunding writ large, and quite a lot of people are going to lose their shirts quite quickly. But at the same time, it's still a valid use case, and a lot of people have been talking about blockchains and particularly Bitcoin and saying, where's the use case? Where's the use case? Well, this is a really obvious one, and it's working pretty well at the moment. But ultimately, what blockchain technology will allow in the long term is for actually far grander goals. And those grand goals will include databases actually talking to each other for the first time in history. It'll include smart contracts where legal documents will no longer be ambiguous, they'll actually be written in code. And that's a future, that's an efficient future which we can absolutely all look forward to. That's all I've got. Thank you.
So next speaker is Robert Benson.
Forwards and backwards. Thank you.
Thanks.
Hello, everybody. Thanks for coming, and congratulations on making it with all the nice weather outside. I know where I'd rather be. But anyway, I was an Imperial alumnus. That says 1992. In fact, I graduated from the management science department here, which was a precursor of the management school that you're, I guess, all in, or some of you, in 1987. So 30 years ago. It was a bit different here then. This wasn't here for a start. But since then, I've gone in a number of different directions, and I started out trading derivatives and then had my own business, a startup, which was a financial data company, which I sold a few years ago. And now I do sort of startup investing mainly, and other bits and bobs. And what Chris asked me to talk about was one particular startup that I'm working with. Well, it's about a year old now. And I guess it kind of feeds off what Matt was talking about a little bit earlier about all this explosion in data and what are we going to do with it, and how can we make money out of it, basically, if you're an investment manager. So what they do is they try and address this particular problem, mainly for hedge funds, but not only, basically any kind of fund manager, fundamental type investors, BlackRocks, etc. which the first problem is these huge data sets that are now becoming available. How do we know what's out there? How do we know what's in them? How can we use them? This is a very small writing, I'm sorry about that. But basically, there's an explosion of that information coming out from all different areas. So there are traditional businesses that are making available the data that they had internally, which was never made public before. So they call this kind of stuff exhaust data. So a company like a big logistics business that's in real time tracking the movements of their tankers all around the world and has discovered from that information that they've got a quite accurate way of predicting trade flows because they know what's in the containers and they know where they're going and they know when they were loaded and when they're going to be delivered, and that will flow through to statistics later on. Then there's all those companies that are new and that are basically being built with the idea of monetizing their data. So a lot of the apps that are on your smartphones that are free, why are they free? It's because they're gathering obviously lots of information and they're selling that or hoping to sell that and monetize it. So there's a huge amount of that information out there, and the first problem for a lot of the hedge funds, in particular the quant hedge funds that rely on feeding their models with this information, is just knowing what's out there. One of the very biggest US quant funds told us recently they've got 2,000 companies that they think have data that's of interest to them. They just haven't got time to look at that. It's just too big a universe, and there's more and more of it coming out. And the second problem is that even when you've got a data set that you've analyzed and you think there's a signal in there that you can use to generate alpha, that's changing also. So they're updating their data all the time. They're making it more granular. Maybe there are regulatory changes that are coming in, which means you now actually can't use it anymore, or you have to use it in a different way. So keeping up to date with what's new and also what's changing in terms of what's already out there is the problem they're trying to address. Basically, what they do is they provide primary research on all these data providers. They have a team of research analysts. They have a team of data scouts who collect that information, what's out there, and then they provide reports to their clients in a searchable database. So if I'm trading the top, I don't know, SP 500 stocks in the States, I only want to know about data that's relevant to those companies. I can search through and find data sets that are relevant. If I really only want to know about social media type data, the Twitter feeds and all that kind of stuff, they can search and look at what's happening in that particular space. So that's the tool that they're delivering. It's a sort of online platform. They get subscription revenue, so it's a kind of B2B business for investment fund managers. And I've just got two examples of the types of data sets, if you like, the data providers that are out there. So this is a company that measures basically location data. Where are you when you're buying that Nike shoe? Are you in the Oxford Street store or are you somewhere else? And there's a plethora of companies out there that are selling location data. Where are you? What are you doing now? And a lot of that data is pretty unreliable, actually. And so what this company does, I can't give you the names of the companies, but what this company does is they effectively source a lot of different pieces of information from your app on your phone, from the GPS signal from the telephone towers, and they triangulate all that, and they can locate you down to pretty much a square yard of where you are and track you around. And that enables them to, in the US, they've got 31 million people who've agreed to have their location tracked effectively. And that can then be used by their clients to track sales of basically retail products as people move around the world buying things. And that's valuable if you're trading, I don't know, supermarket stocks. You want to know how many people are physically going into the supermarkets over time, how that sale that they're doing at the moment is working, how that affects the trend of footfall. So that kind of information is very useful, and it's actually not necessarily useful just to a quant fund, but even a fundamental fund manager, because a lot of the rationale for this is that you can't get this kind of information on your Reuters or your Bloomberg terminal. A lot of that information is just not there yet. So having access to this stuff helps you to be a step ahead of your competitors or of other people investing in those particular stocks. They have an online dashboard that provides basically sales predictions based on where people are physically moving around. The second one This is a US company that originally was set up to, you might have heard of them actually, they were originally set up to collect data on, Groupon was a big thing a few years ago. And there's lots of these coupon sort of companies, particularly in America. So you get a discount if you download the coupons. And they originally were a B2C business, so you could go to their service and you could find out what daily offers are available in your location for the things that you want to buy. But what they actually made more money out of, in the end, was selling that information on what offers are out there at the moment, how they're changing over time, how many people are downloading the coupons, because that's really useful information if you're trading those particular public company stocks. So if Nike's doing a particular coupon offer, how many people are reacting to that effectively in real time? And they are able to gather that information. They have a number of different products and companies that they follow. And what they interestingly did was that they didn't just sell the raw data, because apparently there are regulatory issues with doing that. They hired effectively research people themselves to produce reports based on the data, so they can sell their hedge fund clients these research reports telling them basically how much, what the trends are in these particular companies in terms of their the offers and the sales that they're running on their websites. So that's all I really had to talk about. I'm very happy to take questions later, obviously, but that's it for now. Thank you.
So our next speaker is Oliver.
Great. No, thanks again, everyone, for being here. Quick introduction. Ollie Harris, help lead FinTech and in residence at JP Morgan. Going to talk to you about a few things today in the 7 allotted minutes. The view from the banks, why do we care about innovation? How are we making it real, to Erica's point? I sort of feel Erica sort of stole my speech a bit, so I'll see how I go. So just starting with the why. Why do large investment banks like JP Morgan care? And I've thrown up a few technologies, themes, and trends on this slide. And just to point at a few, again, I definitely had to get in blockchain. I didn't actually get in AI, did I, this time? Data science, I guess, and machine learning, but robots, exactly. Generally speaking, there's, like FinTech, nothing new. There's always been technology in finance. They've always been intrinsically fused together. However, there's a few emerging themes that may have the potential to genuinely transform the way we do business today at JP Morgan. In addition to the technologies, I'd like to highlight UX and design, and I think that's another key factor that some people miss out, which is actually the cultural element, design thinking, agile, lean, bringing our personal lives into work. So I think that's another key point. So again, just summarizing, new emerging themes, genuine potential to change the way we do business. The second point, and don't have a slide for this, how are we actually making it real within JP Morgan? And agree with Erica's point. It's about a portfolio approach to innovation. There is definitely not a one-size-fits-all approach to innovation, especially at large corporates. So we're doing a few things. One, we're actually building in-house centers of excellence within the firm. So this is finding the best blockchain engineers on the planet, top data scientists, great designers, and melding them into our existing culture to sit alongside traders, investment bankers, our operation teams. So I think the first key point is bring the right talent into the firm and ensure you're doing that in a sustainable way to actually fuse new cultures and talent into the firm. The second is actually creating structured ways to engage with the outside world. And I'll use in residence as a case study in a moment, but broadly speaking, yes, we are doing the strategic investments, but we have a very structured way to make it real, which I'll talk about. We're also out there meeting people, attending conferences, events, and I think the key message is we have to be at every forum where there's great experts to actually understand what are they doing, and then how can we translate it back into the corporate core. So none of this innovation lab, ivory tower type stuff. We don't believe in any of that. We believe in thinking through what are our core strategic business priorities and what execution levers exist to actually get things done for clients and shareholders. So, in residence, and I'll just go through a case study here. So, traditionally, if we see an opportunity to deliver value to clients and our shareholders, there's really three ways of getting things done. We can assemble a team, we can build the products internally, hopefully doing that in an agile and lean way, leveraging some of the new ways of iteratively building product and building things. Secondly, we can actually buy things and integrate them into JP Morgan. And the third is we can partner with established vendors. And this is where large vendors come into play. Large corporates are very used to working with big established vendors to actually build product and services. I think where we've identified is a gap, and this is where I would like to say we've created like a fourth way of doing business, which is actually partnering with early stage companies and making it real and genuinely taking companies that may or may not have done an accelerator program, but taking them from pitch ready to enterprise ready. And this is where In Residence fits in. Essentially what we're doing is we're saying, okay, we have a genuine business problem, and we think there's a company out there, an early stage company that is suitable for that problem to actually solve it at scale globally. And what we do through In Residence is we sit down and we say, look, this is where you are today. This is where you need to be to actually get a commercial contract with us, potential investment from us, and actually leverage our network to grow your company and scale. So we're providing, and again, taking them on a journey to give them access to our people. If they need some real estate, we may sit them by our traders. Everything is tailored to the company's needs to take them from where they are today, whether it's their MVP, to actually a partner of JP Morgan and scaled. We also give them technical stress testing. And the key thing here is the concept of someone on the fintech team who is a neutral person, who is representing both JP Morgan and the early stage company, will bring together the right experts across the firm. Whether they need data scientists, engineers, traders, we'll convene the right people and we'll actually help them build their product. They own the IP of anything that we co-create with them. And the really key thing here is we're partnering side by side to actually see if the product works. And if it does work, we take them to enterprise readiness, which is getting through compliance, legal, risk, onboarding, and really bridging the gap on the traditional pain points that large corporates in any industry face with dealing with early stage companies. And the outcome is if we need capital, we'll give them capital, and obviously revenue through a commercial agreement. So yeah, on the working together. So why are we doing this? We're sharing knowledge, we're leveraging assets, we're co-developing products, we're building platforms. The reason we're doing this is to give that optionality to our clients and our employees to get things done in a different way. So depending on the problem, we build it internally. Maybe we'll partner with a large vendor. If we do want to do something with a fintech, we use this In Residence framework to actually make it real. And I think the last point I'll mention is everything we do, to Erica's point, has to be linked to the core of the company to make it real. So if I think through the funnel, we're meeting the companies, we're testing them out, and we're deploying them. There's the product, what do they do? The commercials, how expensive is it? The technology, how good is the tech? And the investment. And the key thing here is through the whole process, we're keeping them in sync and aligned with support from senior management and the people on the ground. So yeah, that is the case study, and happy to talk more on the panel and give the view from the bank.
So Andre will be the last panelist presenting. Thank you.
Thanks for having me here. Really appreciate it. Thanks all for coming. I'm a professor of finance here, and I direct the Center for Global Finance and Technology in the business school. As a finance person, as a financial economist, I'm a social scientist. So I'm going to try to provide a perspective to you that, that maybe would try to summarize on how I view these things. My work is on the intersection of finance, technology, and regulation. But to a social scientist, the big question, if you will, underlying a lot of these decisions is this. Are humans still the best processors of data that's valuable for making financial decisions? If they are, then they dominate technology. If technology dominates them, then their value will gradually erode, or their value will quickly erode, like you've seen on the slide for BlackRock. They'll just be let go and be replaced by data processing technology. And how did we get there? If that is the question, let's step back and ask ourselves, why are we asking this question, and why are we asking it now? So let's go back to the financial crisis. During the financial crisis and post-financial crisis, I was at the something called U.S. Commodity Futures Trading Commission. It's a U.S. markets regulator that was given oversight over the over-the-counter derivatives. So I wrote lots of, cost-benefit analysis type of stuff for regulatory reform to overhaul that whole market. That gave me a view into how technology, regulation, and finance overlap. But what happened during the financial crisis is that it started out in the subprime sector, then turned into a global banking crisis, that turned into a regulatory overhaul that basically went through, pretty much ended in about 2016. It's just sort of been trailing off. Yeah, so during this time, financial institutions, large or small, were in survival mode. They had to survive. They had to comply with new regulations. They had to figure out how to raise capital. They were in survival mode. At the same time, in around 2007, 8, and 9, 3 key technologies came about and became publicly usable that changed the economic value of computers relative to humans. These 3 technologies are cloud computing, offered by Amazon first in 2006, 2007, which basically made it lower the barriers of entry in terms of computing power that you needed to run your business. The second technology that came out, iPhone came out in 2007, I believe, mobile telephony, and became very widespread. And the third technology that came out in 2008 is Bitcoin blockchain. Large financial institutions are in survival mode. They're not in a position to internalize these new technologies. They get overlooked. That paved the way for smaller startups to be able to enter this space and compete with large financial institutions. And what's underlying this sort of theme that we're seeing is all of these technologies data processing is native. And it used to be in the past that humans, which we still train here at the Imperial College Business School, to go out there and serve in financial services, were better than computers in a lot of the tasks. Onboarding a client, issuing deposits, making loans, giving advice, trading, reconciling payments. Humans were just better in terms of their processing capacity. Now, those businesses have become data processing businesses, and computers are just better than humans in doing that. So that's just the fact of life. And so you can see that as the cost of doing that has come down with these new technologies, so the economic value of humans in the space is increasingly being questioned. So what can humans be good at? How can they compete with machines that go into the space? But don't make any mistake here, because what you've heard from the previous panelists is that they are figuring out a way to to replace lots and lots of humans out there in the financial services sector with digital technologies. Because not because they're mean people, I like them all, but because digital technologies are better, cheaper, faster, more efficient in generating that economic value. So where can humans be competitive? What can we do about, how can we participate in this? One way of doing it is join the, club, work within the community that's redesigning the financial services system. You will be then part of the redesign effort that's going on, and you will understand where the trends are. You'll at least be able to see the future, position yourself a little bit better. And once you start positioning yourself a little bit better into the space, you'll start understanding that there's still a lot of tasks that computers are good at, but they need to be trained. Like artificial intelligence and machine learning requires very large training sets to actually condition computers into start making decisions that sort of make sense. During that training process, there's still quite a bit of value that could be added from sort of human-computer interaction and may not sort of go anywhere. Other areas, that regulatory technology could be another area where part of it could be running on sort of human-computer symbiosis. It will sort of remain to be seen where it is, but I think post-crisis in particular, what we've seen is that financial services industry used to be human-centric, and technology used to be on the auxiliary providing support. It has changed. Now it's technology-centric, and sort of humans need to figure out how they service this technology. Some of these businesses, as you've heard, are now designed from the start, from scratch, as being technology-native businesses. Yeah, so that is an example of redesign thinking, thinking that this is what the future is. For the right economic reason, because that's where we are in terms of processing data. The value of whatever it is you do, if you're in the financial services industry, you need to think of yourself, my value comes from finding data, processing data, storing data, analyzing data. How am I valuable? How can I position myself? I'm available for questions. Thank you very much.
Thanks very much.
Right, so I think we have a Mentimeter question coming up. So you can use this code, and is the question on the next slide?
Yeah, we like to keep things fairly interactive. So if you take out your smartphones as per usual, log in here. The question actually is normally at the top, and it is asking your view on which technology is going to disrupt financial services. So we want to hear your view. We'll try to broadcast results at the end. If we don't have time, we'll send it in the email afterwards. So
we heard many different perspectives. Lots of themes actually came up through the 5 panelists, and we have 40 minutes more or less reserved for questions and answers. So I would invite the floor, for any questions. Yes, please.
I act as a mentor for small business, and I come across various fintech prospective businesses. Fortunately, typically, they're usually looking for new applications, new solutions, rather than replacing existing ones. However, my question stems from that. In order for them to commercialize their opportunity, is it best for them to approach a JP Morgan and get into bed with them, or is it for them to approach challengers, smaller, faster-moving businesses, and that's presupposing that the team have got the expertise to build strong relationships with the tax authorities, etc., etc. In other words, they're not amateurs, but they have sufficient expertise to see a route. Which would you suggest is the best route for them to commercialize?
Very good question. Who will?
Sure, I can have a first go at this. short answer is it really depends on the problem. I know that's like an annoying answer, but depending on the actual problem, we may be right, we may not be right. And I think the duty is on us as a large investment bank to also be honest with ourselves. And if we're not the right partner, then we want to say no as quickly as possible. We know time is limited. I think if we are the right partner, and you are at a position where you have an MVP, it's relevant to capital markets and wholesale banking, most probably we are going to help you and also convene the right people, not from just JP Morgan, but the wider industry.
Thank you. Anybody else?
I think the one thing that I would comment on is that the risk that you run going to any particular bank and working only with them is that you design something that really only serves their needs and is quite integrated with just their banking systems and is not as flexible or I guess saleable to a wider market than the initial intent, and you end up becoming a service provider to that one bank. So I think that you really have to be careful about making sure that the product serves the diversity of needs that exist in the market related to that problem set or that use case.
Yeah, agree entirely. I think we're not here to create like vassal states of JP Morgan. Like everything, any time we partner with an early stage company, it's always industry-wide problems. And again, also on the marketing front, sometimes we don't even make it public that they're working with us. It really depends on the company and how comfortable they are on the PR front.
Maybe I'll just add a couple of things. So I think to me, from what I've seen, just looking at different business models, it really depends if it's a B2B or B2C. Yeah, so if it's business to business and a business to consumer, these are sort of different models. It's been very difficult for B2C businesses in particular because the customer acquisition is the biggest problem of fintech startups. You know, you have to go and acquire those customers, and that's your cost, and you have limited amount of resources, limited amount of time. Everybody's copying what you're trying to do. And the decision then sort of arises as, can you do it on your own? Are you fast enough to do it when you're burning through this capital acquiring customers? You've seen the slide Monzo. You know, Monzo was here, you know, CEO of Monzo was handing out, you know, prepaid little cards, you know, to acquire customers. I mean, it's really to that end that, like, you know, C-level people are in the business of customer acquisition. B2B is different, yeah, so you don't need, you're in a different model, you're in a different space, you can think of, you know, how you position yourself. B2C is just brutal.
Yeah, there's a question about it.
A lot of the discussion today has been around data and the way that the methods in which that data gets gathered and collected and then analysed. And I just wondered, from the panel's perspective, obviously in the next 2 years, this new legislation is going to come into force. I work in the marketing industry, so it impacts brands more so than financial services as such, in terms of GDRP. I think I got the letters right in the right way. But it basically puts more control and power into the consumer's hands about what data they provide to brands and financial services companies. So how do you think financial services industry will cope with that? I mean, the brands themselves, I see several reports where most brands are just ignoring this issue. But for data companies that are collecting, aggregating this information, how do you think the industry is going to respond to this challenge?
It's an excellent question, and I was actually quite surprised that the acronym didn't even show up in any of the 5 presentations, so please.
Maybe I'll talk a bit about it. I'm not an expert on it, but I know that from New Data's experience of sourcing and trying to analyse the data sets that are out there, and there are many hundreds of them. Many of them are consumer data. So, for example, I know they've been working with a company for a while. It's a credit card spending data, and obviously the point about that is that the individual agrees to share their anonymously to share their data, but it's an incredibly sensitive area, and for many of the hedge fund clients, they won't touch that data because they're too scared of individual spending patterns coming through somehow in an erroneous way, but accidentally revealing what you've been spending at Selfridges or something. So there is a very high awareness, at least I know in many of the top quant funds, of not wanting to get too involved in consumer data. Yeah, that's too granular, or that is even where they're not sure of the quality control processes around the way that data is being gathered and delivered. So they're very, very concerned about how the quality control is set up, and the fact that the company that's generating all this information and says, oh, we've got all this data on our users, that must be really useful. Yeah, but the first question isn't how many users, it's how do you control that data? How do you permission it? How do you make sure that people are actually opting in to allowing people to use it? And I think, at least in that world, in the hedge fund world, because perhaps they've had their wrist slapped so many times on other things that they've done wrong in the past, they're very, very aware of not wanting to touch information that's too close to that.
And as a technology person, I can also add there's been recent research last couple of years on re-identification based on metadata alone. So even if you have these anonymized data sets, you might actually be able, with 2 or 3 external indicators, to really identify individuals, and that's a huge concern also from the upcoming legislation.
Yeah, and I think both of these things you can think of is that you can either add a technology layer on top of it. You can encrypt this data, and then you can only unlock pieces of data subject to the subject to agreement of portions of the attributes being unlocked. Or you can put an analyst layer on top of it who would be analyzing this data. In both cases, what this would do is that would make use of this data for the purposes of making economic decisions more costly. It's either more costly in terms of technology, or it's more costly in terms of analysts, which would mean that the whole idea of democratizing the use of data, that goes against that. That becomes less democratic. So it's still not costly enough for BlackRock. They'll still use it. But for smaller hedge funds, it just becomes prohibitive.
So if someone could invent an audit trail type platform, then they've probably got the collection of data issue cracked then.
Yeah.
It's all about, I think, from my understanding, it's about creating that audit trail so that you're seen as transparent in the way that you collect data, keep it safe, and then, depending on the permissions, how that customer decides how it's being used.
That's costly, right?
Yeah.
So this is just costs.
Yeah, and also there's a sort of a workflow in the data value chain of big data processing. You might actually have decentralized data sets, and so you have to do this locally. And that's actually, the research is just ongoing on that. We don't quite know how to do that. I think there's a NISA report on that very issue, which I can also point out after maybe.
And people might permission it and then change their mind.
Yeah.
So
Yeah.
it's an ongoing process.
Yeah. And for brands at the marketing front end, it's very pertinent because that's how they sell to customers, certainly from a user UX perspective, not understanding that value chain right the way through to the end transaction. If they're not able to collect that data, then it's not informing the customer journey.
Yeah, thank you.
Hello there.
Oh, sorry. I just saw that hand. Sorry.
Okay, thank you. I would like to pick up a couple of points that Professor Kirilenko underscored, and bringing my experience of more than 25 years in the investment banking. I totally agree that the finance is a social science. So I feel that sometimes we overstate the importance of the data and the artificial intelligence in making decisions. I've seen so many times hedge fund not performing at all or having big loss in the portfolio. I would be scared that every time we pretend to have an easy solution coming from a computer in this kind of decision making, which creativity and something unpredictable can make huge difference, can somehow overstate the importance of the artificial intelligence. And I mean, I don't want I mean, the second point I want to make is, I personally believe that we are at risk of having the next bubble coming from the fintech. So I believe that, I mean, fintech is great. I think there's some areas which startup can do way better than banks. But again, I think sometimes we overstate the capability of small company to take away business from the banking sector.
So if I can just maybe augment that as well. So it seems like one could have a blind trust into machine learning, right? And then just sort of take that and make that actionable. Whereas you might actually have to ponder what these things mean. So I think explainable AI is a big buzzword in that kind of space. So what's the reaction of the panelists there?
Maybe I'll start.
Yeah, sure.
Yeah, since I got this genie out of the bottle. And first of all, I'm perfectly fine with having a bubble in fintech. Why not? Okay, let's all this money that the central banks pumped into the financial system, let's a lot of it end up in support digital technologies. Is that bad? Why not? If some of this money will get burned with the experimentation, maybe some of it will end up being useful, and we're going to learn something from it. And experimentation in this space is long overdue. I mean, the Bank of England started issuing licenses in banking licenses after like 150 years of not issuing licenses. That's just like too long. Yeah, let's issue new licenses. Let's have these banks go out there, try at it, see which business model really works. Customer acquisition in that space is, as I said, is brutal, but they come up with different business models. Some of the money is going to get burned. Some of your money, I'm afraid, people who are investing, yours in particular. But so be it. Yeah, I mean, these are investors who are going into the space. They're intelligent. They know what they're doing. They're hiring teams. They're going to burn other people's money, but they're going into this with partially opened eyes. And about the other bit, from what I've seen, I started studying by looking at technology in markets. Technology in markets in particular resulted in algorithmic and high-frequency trading. Very much changed the paradigm on how trading is being done. And together with sort of finance is also a heavily regulated industry. So regulators get into the space, do something. Technology is overlaid on top of it. Then there are human incentives involved. One of the things about machines is that they don't need to be incentivized the same way as humans are. They don't need to be paid annual bonuses. They don't need to be given corner offices. That changes things. If there is really value in there, then the system of incentives becomes different, and whoever is left and needs to be incentivized differently, perhaps through smart contracts. I don't yet know what it's going to be. So whatever social science is going to be looking at in how the remaining humans are incentivized in that space is going to be quite different from the way they were incentivized before. That happened in markets, very much happened in markets in a variety of ways. What also happened in markets is that now we have flash crashes. With technology, you have risks that you didn't have before. With technology coming in into data processing, we're going to have cyber attacks. We're going to have identities stolen. We're going to have people complaining. We're going to have regulators stepping in. These technologies that I described, cloud computing, blockchain, and mobile phone and mobile telephony, it's supranational. It doesn't have national borders. Regulators are national regulators. They're going to be figuring out how to do with supranational technology within national borders. All complicated issues, but social science will I think it's going to be affected in ways that I'm just sort of seeing it's going to be very different from the way it was before.
Well, just to add to that, machine learning as such has been a benign discipline, so it's just beginning to be research on adversarial machine learning, to understand how these things could be manipulated in a hostile environment to actually influence decisions in ways that the financial players would not want, so.
I think another point is that, as probably said, the trading philosophy of banks has changed because now trading is extremely time-consuming. So if you go in that direction of more flow trading, not taking position, looking at benchmarking, so you don't need to guarantee overperformance, but just be at the benchmark? Yes. My question is, I mean, are people keen to pay this level of fees to having a benchmarking, asset management?
That's incentives. So the incentives have to change.
I think it also depends on the context. I mean, I think, at least what we're seeing with Betterment is one of the ways in which they're, pivot is not the right word, but the way they're expanding is actually offering their services in a B2B context for managers. So if you have a financial manager, they can use this to be able to service many more customers more effectively, but still give the contextual information related to, well, your retirement or your life stage or your particular goals. And you see the same thing in health, right? If a algorithm can better identify whether you have cancer or not, you still don't want the algorithm to tell you the answer. You want a doctor to do that. You want to have somebody who's going to respond to you in an emotional way. And so until, I mean, I'm not going to say always, but for a very long time there will still be use cases where a human delivering that news or a human augmenting that experience is going to be incredibly valuable.
I think you tapping the issue of the rising 2 billion of the poorest and countries that they are jumping into this smartphone technology. We have seen it with Nigeria in less than 10 years booming up. And these 2 billion people are getting in. How are they going to affect, number one, all these big banking establishments? Because they have a completely different mentality of how, and we don't know how they're going to react, the others. So how is this 2 billion in the next 5 years going to impact all the financial institutions, big, and the new startups, the new fintech?
Very good.
I think one place they're going to do it is alternative credit rating. Right? So I think there are a lot of really interesting things that are happening in emerging markets around alternative scoring, where there isn't data, like identity, where there's no papers, where there's no data on credit history, where there's, that type of situation, they will have to solve it in the emerging markets maybe first or more consistently than what we see in the developed world, and they will actually champion some of those approaches. So I think that there are particular places where not having the legacy is actually a competitive advantage.
Yeah, I'd echo that. So I suppose when any decent business is built, a whole load of customer development and customer research goes into it. And this, to say that 2 billion people have the same characteristics is clearly rubbish, but as a general sense, as Eric is saying, they were previously unbanked, they may or may not have identities, they sure as hell don't have credit histories, they don't have passports, they don't, who knows whether they have ownership of anything at all. It's a totally new set of variables, and as a result, it will spawn a totally new set of businesses, a new set of risk scoring and pricing for various different financial services. And fundamentally, the answer to your question is it will be different because it needs to be.
I'm just going to make a comment about the conversation you had before, if you don't mind. Basically, funnily enough, my colleague and myself, we started electronic trading. He was at UBS, I was at Credit Suisse back in 97, 98. We were probably the 10 people in the city starting electronic trading. We then moved to algorithmic trading. We developed all the algorithmic tools, black boxes, up until we left the dark side and set up our own business. Now, when we started back in 97, 98 with electronic trading, which was literally, hey, mate, instead of calling your friend to send him an order to execute, sell 2,000 Vodafones, why don't you actually use this and you don't go straight to the market and whatever. And there were certain countries, among them Italy, Spain, where they were reluctant not to use it. And they would say, well, I call my friend Pepe 100 times a day and he tells me how many shares I've executed. Now, we've lived through that. We've lived through the first quant boxes and the algorithmic and the strategies and whatever. Now, I will tell you something. Despite all this electronic trading and algos boxes, black boxes, whatever, high-frequency trading, you name it, the contact with a human being has always been there. Maybe the guy didn't call me 100 times anymore, but I would know who my clients were. They would call me. We would always be working together. So that human interaction has never been taken by the machines, despite the fact that my clients didn't have to call me 100 times. So even though now with artificial intelligence, data, etc., I don't think there is so much of a risk of the human is gone, he goes, lives in a box, and is never used again and is replaced. So that's my comment about that. I think Fernando wanted to say something different. I don't know if you want to reply.
Sure,
I didn't ask a question, but it was
Or is there any reaction from the panel?
Yeah,
Wholeheartedly agree.
Yeah, I mean, it makes sense. I mean, I think what you just described is I think what I summarized as being your business, you're as a trader being at the center of the business, to your becoming a customer-facing auxiliary function, and the business is being done by the algorithms, whereas you are now on the periphery of this, interacting with the customers, providing user interface. That is what's happening in many other areas, in wealth management, in payments, in banking, in customer onboarding. So, and it's enabled by technology, different type of technology than the one that you were using. You were using, stacks and stacks of CPUs, and now that is being done by clouds. But that's what makes it possible, yeah. Because your algorithms wouldn't run unless you have the stacks of CPUs to be able to run them. So technology enabled, and then which pushes you on the sort of auxiliary function.
Yes, this is like going. I just wanted to share a frustration and gather your thoughts. So we're actually fintech entrepreneurs, and we're just close to release our app. And one of the things that we've crushed on is the fact that no matter how innovative you are and how great your idea is, at the end of the day, you know in fintech specifically, you actually depend on legacy systems, on your bank, regulations, compliance, and obviously all of those things are not as innovative as you would like. I know that many banks and companies out there are trying to open programs and accelerators and whatnot, but the reality is that these guys are constrained by strict regulations and fines and obviously reputation to the business model, right? So unless that changes, we are at the tip of the iceberg of the fintech revolution, right? But unless that changes, a lot of the companies like ourselves and many others that I meet won't be able to advance as quickly and be as innovative as we would like, just because we are always subject to legacy. And I know that there's obviously things like blockchain and other sort of payment networks that will disrupt. But unfortunately, there's a vicious circle because the consumer, the trust, we're prisoners of trust, right? And the consumer actually trusts legacy, right? That's all they know. They want to know that their money is at Barclays, not at a new, bank called, I don't know, prepaid financial services or whatever that actually issue accounts and have APIs and blah blah blah, right? They say, who's that? I know my money's safe at Barclays, not at this new guy, right? So, there's two things that need to shift: either legacy or the trust of the overall mass, right? And it looks like, hopefully the trust is actually shifting quicker than legacy, right? So people are actually trusting the Monzos, etc., much quicker, right? But I would like to know your thoughts on how to break that vicious circle.
Thank you.
So I suppose what you're outlining is the frustration of acting in a regulated market.
Can I say something?
But of course, yeah.
Out of 3 years of building the business, somebody said to me the other day, what has been your biggest challenge? And trust me, we've built something which I always say is not smaller than Buckingham Palace, yeah, because it's a complex thing. And you know what has been the most difficult thing out of a 3-year journey? To find a bank. To find a bank where I can put the money. I'm not telling you that I want a bank to do, to send me to Mars to have a coffee and come back. No. A place where I can put my investors' money.
So you built the Buckingham Palace, but you can't get the electricity into the palace.
Exactly.
You can't connect it to the power line.
One bank, and we stopped to
It's a great palace, it just doesn't have any power.
Exactly. Until we went to a bank called Tide, that surely you know.
Yeah.
We're invested in them.
Right, and Tide changed our lives. You see what I mean? That is what I mean. It's like such a stupid thing as saying, can I have a corporate account? No, because of the type of business we're into. That's what I mean. It's something as silly as, open a bank account. Sorry, I can't.
Yeah.
Maybe the solution is fintech supporting each other, right? So
That's one way, yeah. And there are a handful of startups that are addressing this. Rails Bank is one example, but are really looking at the infrastructure layer and the legacy issues and the difficulty of integration that exists between the startups and the traditional banks. There are a number of ways to address that. You can kind of dip the legacy in candy coating and just plug into the outside, right? Or you can actually try and build it from the ground up, and maybe many flavors in between, but it is definitely an issue that we see repeatedly, and I'm glad that Tide is a viable partner for that.
And blockchain is a good sort of comparison there. You can think of this as a reformation in a Lutheran sense, or a revolution in some sort of South American sense, of history. So, and I think it will be more a reformation, I think, smaller steps.
And so just to that second point about consumer or even business trust, I mean, you're absolutely right. Any new business struggles with that, getting the user's trust, and it's of particular importance in banking because current accounts have proven to be far more sticky than anyone ever thought. And as a result, people like Monzo have their CEOs handing out cards trying to acquire you as a customer. And so I suppose the balance as a business that you need to strike as an early stage business is utility traded off against that trust. Tide is a great example, right? So Tide will have had similar problems, right? Getting electricity into the palace, but oh dear Lord, Tide solves a really acute problem, and so the utility is there. So provided you have that equation well balanced, you should find it perhaps easier rather than less hard.
I guess obviously Tide has resolved the problem, and they've been fantastically useful and they're great guys. But the reason we actually arrived to Tide is not because Tide was our first choice. Our first choice was Barclays or Lloyds, with whom we spoke probably like 9 months, right? And at the end they said no. But I guess the issue is that the problem with legacy and actually working in a regulated market, which you pointed out, Matthew, is that at the end of the day, legacy is generally quite square, right? When they assess a business, right? So because there's a huge risk at stake for them, but it's the computer says no element, right? So if I provide, I don't know, a 50-page document around what I'm doing with KYC, anti-money laundering, how I'm complying over and above any standard in my business, computer says no, right? Because they don't actually analyze the business, whereas someone like Tide is much more open-minded to actually sit down and understand what you're doing.
Thank you. We have time for more questions. Maybe there, yeah.
Hi, great presentations earlier. Thank you very much. So I just had a couple of points I wanted to raise. So firstly, Monzo's been raised up a lot today in passing in conversation, and it was interesting because today actually in the news, they released the fact they've lost 7.9 million this year. And I'm just interested to know that we say that fintechs are going to change the way banking, they're hiving off segments that weren't profitable to make it. But When do we actually think that they will actually be able to make a profit of this? And I'm interested because I actually feel that what I am actually seeing is, so they, your point, they went down the B2C route. Customer acquisition was very expensive, and the distribution channels they don't have. So they're now partnering with the major banks. But surely then what will just happen is they get sucked into the major banks, and actually the major banks will just gain the profit from those businesses. So that's the first point I'm interested in. Then security and trust. So what you notice in China very much now is that the big tech companies are the ones that are actually moving into the banking sector and payments. So you think Alibaba, and you think WeChat. And I'm interested to hear your thoughts there. I actually think when PSD2 and GDPR come in next year and beyond, actually it'll be the GAFAs, so Google, Amazon, Facebook, Amazon, that will actually overtake the fintechs and just move into that space. They've already got the customer brand, the customer scale, and they've got the funds internally to be able to build a lot of these products. So just those two areas I'm very interested in hearing about.
Thank you very much.
I'm happy to speak to the second point.
Okay.
At Money 2020 last week, Amazon basically said, hi guys, the whole audience is banking industry, right? We are going to be the traders in trust. Thank you very much, goodbye, right? I mean, they are absolutely dead set on doing that, and the banks are totally unprepared for technologies to come in, technology companies to come in and eat their lunch.
And that's actually a wider point. It's not just the banking sector, it's also the food sector, like the crafts of this world and so on, which is a reasonably scary thought, maybe.
Yeah. I guess on the first point, a couple of things. One is the window of time. So time is of the essence. It's both for you and for others, because time is of the essence, especially now, because financial institutions have basically digested the regulatory reform. They have large war chests. They figured out how to hire data scientists. They're prepared to take challengers on, full-fledged on. Exhibit A. Okay, so time is of the essence. That time that was available to go into that space when they were busy surviving and dealing with regulatory overhaul and all of that, that time is over. A completely different environment now. So you're in this environment now. You have to position yourself differently. You now know that you're not just going to sort of be able to experiment and get things right, maybe. So what is the most valuable thing left in sort of a mobile banking business now is going to change. One valuable thing mobile banks have that they didn't have before is a license. License is valuable no matter what. No matter how much money they lose, it's a valuable proposition because they've been licensed. There have been no licenses for 150 years. New licenses have been issued. It's going to remain valuable. They can directly access customers. The second bit is that the things where I've seen, the ones that I in particular paying attention to is there are two types of sort of business models that are of particular interest. One is if there is a business model that builds rails as opposed to outright solutions. Instead of building the app, it builds rails on which multiple apps could be issued. One example of it, for example, not Monzo, but Starling Bank. So Starling builds rails. On this rails, it could deploy anything. Insurance, banking, payments, lending, checking accounts. That's competitive. They're going to compete, yeah? So they will see how well they do.
Sorry, insofar as that's the case, I think, sorry, what's your name? Opie. I think your intuition about Monzo is exactly correct. That they've hived off what is not a particularly profitable bit of banking, right? So current accounts are not where banks have been making money. Banks make money from lending money. They can make it from overdraft charges, but that doesn't really fit in with the whole new tech startup-y thing at all.
And as far as I know on Monzo, their API is not theirs. They didn't build it in-house. Yeah. So they rely on others providing this technology, which made sense 3 years ago, but now it's a different environment. The second interesting type of business is if you can go in there and you can establish a standard. If you're a standard setter, a data standard, a technology standard, something that everyone is going to be using, and you are going to be the one controlling that, that's viable. Yeah, other things, when you're going out there and competing for customers, when this guy's got a lot of money and don't have to deal with regulators anymore, it becomes less viable.
Yeah, I think just building on a few points, I think whether it's technology companies, startups, or incumbents, it's about building delightful products, and ultimately, like, you have to satisfy a client need or a customer need. And I think each of the different stakeholders are coming from different, positions of strength, and are rapidly trying to, plug weaknesses, whether it's like design thinking, data scientists, and time will tell.
Like even a year ago, you wouldn't hear from a JP Morgan person, we're in the business of building delightful products. Now you do. Yeah?
Thank you. I think we have time maybe for one more question. Yeah. Anybody? Yeah, thanks. Yeah. Maybe just wait for I get it all the time. Just wait for the mic.
So,
Yeah.
yeah, I'm interested in your reaction to the problems which all these databases pose in cybersecurity. Now, obviously, we have ransomware and things like that which are happening at the moment. But what happens, for instance, taking the medical database, which doctors use at the moment in the initial analysis? My sister's a doctor, and we actually changed one aspect of that database, just one thing. And she came up with a different set of conclusions which put people's lives at risk. So if somebody decided to change a database or change something in the big data wherever it's stored, hacked in, did something, this could damage millions of people. The same way as ransomware today is obviously disabling hospitals, businesses, etc.
So this is a question about the resiliency of databases and distributed data and how it informs decision making.
I might even add to that the idea of data doping.
Yes, and the other thing, of course, is artificial intelligence. If you use artificial intelligence to analyze the database, a human, for instance, a doctor, may notice the difference, whereas analysis by a machine wouldn't.
Yes, and that resonates very much with the question we had earlier about the machine learning. So, I mean, maybe I can take some of that. So I think one of the key things here is also to look at replicated database solutions that are immutable in some sense. So you get a high degree of trust, and that's actually where blockchain has its actual proposition, because if you're not caring about immutability of data, you might as well use existing security solutions of distributed systems and databases. So I think there is actually a huge potential of blockchain, where the business cases are actually maybe just discovered. So these are not the obvious business cases like supply chain management and so on. So it's actually the resiliency of medical data, say, and that might be a costly operation, proposition for a government at this point. But
well, the one solution I've heard of is obviously not available yet, but it's quantum computing. And when that comes into the arena, obviously that should solve the problem, but we're not there yet.
Create more problems, because that pertains to the resiliency of the cryptography being used in getting the immutability in the cryptographic layers of these blockchains. So that's a huge issue. Can I just point out, in Estonia, there's a startup that actually does those kinds of things for the health service there. And I think they can do this because the nation is reasonably small, so you actually get scalable solutions. And I think it's just a current problem to scale this up to, say, 65 million in the UK or something like that. Yeah. Right. But I think over time, I think solutions will be found for that.
I mean, I think it's for absolutely an issue, but if you ask anybody in IT security, the biggest problem is the human.
Yeah. Exactly. Yeah.
Right. So.
Well, the standard thing when I was a young man was you had something like a PET or a BBC Micro, and it was garbage in, garbage out.
Yes.
So, all you need to do is change one little thing on a database or hack in somewhere in today's world, and you've literally created that system.
Yeah. Thank you for that. I think we coming to a close, so I would like to thank all the panelists. So it's Robert, Oliver, Andre, Matt, and Eric. I would also like to thank all of you for coming. I appreciate we had some competition, including on Center Court, and also Christopher and the team from the Enterprise Lab for setting this event up, which was very, very interesting. Thank you very much. Thanks all for coming.
And lastly, a huge thank you to Michael as well, who hosted this event. So everyone, there's drinks and networking outside. Do please join us. It's just outside.